This is the Real Estate Guide to Success video series. I'm Vance Poindexter. Today we have via Skype Mr. Ronnie Adams. There you go.
What's going on? What's going
All
on?
right. Today we have a listener question from our Facebook page. Mr. Alan Butler submitted this question, and Alan wants to know about refinancing his rental property.
Okay.
He wants to know, what are the banks looking for? How do you do it? I think from a more general perspective, I want to know, why would somebody want to refinance it in the first place?
Yeah.
You can kind of go into some of his questions.
Okay. Well, refinancing, most people think of a typical refinance is when you already had a mortgage on the property.
Right.
So then you're going to place another mortgage on the property that would pay off the first one, you know. So that's pretty much what a refinance is saying that you are financing again.
Why would you want to do that?
So you're going to do that to get a lower interest rate.
Okay.
Better terms for the loan, whether maybe you were on a 30-year loan and then you say, okay, I want a 20-year. So then you drop it down.
Okay.
But for a real estate investor, we're pretty much doing it so that we can get cash out.
Okay, so the value of the house is higher than what you owe.
Yes,
and you want to get the money out.
So then you may be able to grab out, $10,000, $20,000. So, but we would not do it, or at least I would not do it, just to, because most of the time all my mortgages are 30 years anyway. So, that's the typical. So I'm not going to have a 10-year mortgage or even a 20-year mortgage. So I'm not going to go for the longer term, because I did the longest I could do from the beginning.
But you would take the money out to maybe put down on another property? Is that what you're
Exactly.
saying?
Or you're going to take the money to have cash in your pocket or whatever. You're going to build, because the more money that I can get out of property and I can show that in the bank, then when I go for another loan, then I'm going to show more, I'm going to look stronger, because I'm going to have additional money or a higher amount of money, cash value, in my bank account. So it's always nice to look.
That's not offset by the debt that you're showing on the other side?
But remember that the debt that we're showing is being offset by the rent that we're bringing in. Okay. So the bank, what they're looking at is, okay, you may have a mortgage for $800 a month, let's just say, with taxes and everything, but you're bringing in $1,400 a month. So that rent is offsetting that mortgage. So the as far as whether you qualify or not, then you're going to show in the good. Okay. Now, most mortgage companies or most banks, they're going to take a percentage of that rent, and so as long as what percentage they take washes out the payment, then you're okay.
Okay. All right, so let's get into some Alan's questions then. I understand why somebody would want to do it now.
Yeah.
His questions were, what are the banks looking for, and how do you actually do it? What are the steps?
Well, first of all, the bank is going to be looking for your credit. That's the first thing they're going to do. They're going to run your credit. We're going to see if you even qualify with your FICO score. Okay. Because most of the time, if we're talking about a bank, then, and if you're talking about any mortgage company, they're going to have, their entry-level qualification is, what is your FICO score? If you're too low, then we're not going to do it. After that, they're looking at the property itself. Like, what type of property is it? Is this a single-family home? Is this a multi-family, unit? Is it a condo, apartment, whatever? Okay. What is it? They're also going to look at whether the property, what's the loan to value? Now, the loan to value is, how much is the property worth, and what loan are we going to put on this thing? So the mortgage company or the banks, they're going to look at it and say, okay, for a rental property, we're going to give you 70% loan to value. Okay. Now, they're going to give you 70% of whatever that house is worth, what the appraised value comes in. So as long as that's going to fall into their criteria, then they'll say, okay, we can come on and put the application in. Okay. Once they're going to put the application in, they're going to want to look at that bank account. Let's see how much money that you have in the bank account, because they're going to want to see, do you have the funds to close the loan? What is the, if they say that you need, let's just say $3,000 to $4,000 to close the loan, then they're going to want to see that you got $3,000 or $4,000 in the bank.
Right.
And they're also going to want to see that you had the, like 6 months of escrows, to pay the payment.
Okay.
They want to make sure that you have that in the bank also.
So do they look at you differently whether you're refinancing a rental property versus refinancing your personal home?
Yeah. All the time, they're more favorable on a home that you're living in or your owner occupant. The way that the lenders are going to look at it, they're going to say, you are most likely going to let everything else go before you let the place go that you're living in.
Okay.
So it'll be much more favorable. But now when we're looking at refinancing, opposed to getting a first mortgage, then the refi, generally the closing costs are much lower.
Okay.
So, it's always good. Like, I could go, even if I paid cash for a house, once I go to a bank, they look at the first mortgage as being a refi. It's the same thing. If I went to a mortgage company or a mortgage broker, then they're going to look at that as being a first mortgage. Okay, I'm going to go through the same closing costs as if I were to purchase the house with that loan.
I see.
But when you go to the bank, they'll look at a refi differently. And the closing costs are much cheaper. That's why we always want for our viewers to go to a bank first. You want to get the best deal there. But if you can't, then you just move on down the line to the next one.
But the issue there is credit, right? You have to really have your
your credit's got to be, your credit has to be up on time. Banks, again, they're only going to hold a certain amount of loans. It may be only 5. And then you have to go to another bank, or whatever like that. So, it's a little bit more foot running that you have to do on your own.
So what about the application process? It's pretty much the same as for anything else?
The application process for a bank, and especially if you deal with the bank, then it's much easier. They're pretty much looking at your credit. They're pretty much they may ask for your tax returns, just like a regular mortgage company. But they don't go into, like, say, your tax returns for the last 2 to 3 years. A mortgage company may want to see your tax returns for the last 2 years at least. The bank's most likely not going to do that. The bank most likely is not going to want to see, 3 to 4 months of your bank statements. A mortgage company is. So the bank they really take the application process and they shrink it down to like 10% of what you would go through if you were to go to a mortgage broker.
All right, so let's talk about you personally here. So have you refinanced any of your rental properties?
I refinance all my rental properties. So at one time or another, generally, and it's funny, we have a bank here that used to be Commerce down there, TD Bank. So I believe that it's a Canadian bank. But when they were Commerce, I happened to be friends with the office manager, and you just happened to be talking one time, and they said, well, how about if we do a couple of your, now this was when the market was great. Everybody was looking for people, How about if we refi a couple of your properties? I said, at that point, I wasn't using banks very much. I was just buying the house cash. I was fixing it up. I was flipping it, So, because there's still some stuff you got to go through with the mortgage process, and I had got tired of it, I don't want to do it no more. I'll just pay cash and I don't have to deal with them at all. So they said, let us give it a shot. I don't really want to do it. It's not, come on, please. Now remember that I would go into a bank in sweat clothes, it wasn't like I was dressing up anymore, so I just happened to be in there talking, shooting the breeze. By the time everything was said and done, it was like maybe 4 months later, they had refied all of them. So, and the closing costs were nothing, hardly. I mean, they may have been a couple $100 per property, The interest rate was much lower than what I was at before, so my payments dropped.
Sure.
I actually refied the properties. I took out a couple $100,000, and my payments actually stayed the same because the interest rates dropped.
I see.
So the amount of money that I was making per month never changed.
Gotcha.
So that's why we as investors want to refi, because we can end up, Now remember too, that money that you take out is a loan. It's not taxable,
Right.
So that doesn't show on your tax returns or anything like that. So the only time that you have to pay taxes on it is when you sell the property.
Okay.
So.
Great points. So wrapping up here, we've been going for a little bit here.
Yep.
You gave some pretty good information about refinancing a rental property. Hopefully that answered Alan's question. As always, if you have any questions, you can always shoot us a email. You can shoot an email to Ronnie@realestateguidetosuccess.com, or you can go to the Facebook page and post a question there as well. As usual, we want to encourage people to check out our free investing email course. That's available at www.realestateguidetosuccess.com/free course. And I guess we'll see you next time.
All right now.
All right, thanks.